Hey everyone, this is Angie with Ohana Investment Partners. Welcome to our bi-weekly webinar. Today we are going to talk about stocks versus the real estate market and a comparison of risks. We typically do these webinars every 2 weeks because a lot of our investors are actually viewing these webinars after hours. We're going to move to a format where the webinars are actually pre-recorded and you'll be able to find them on YouTube. So you'll get a notification and you'll get more details on this in the newsletter that is coming up, and we'll make sure you have the link to YouTube, but that's where all of these recordings will be moving forward. And that will allow us to host a webinar once a month, larger format webinar where we may have some guest speakers come in, and we can do it in the evening so that there's a little more accessibility for people that are still working or want to keep their full-time jobs. So that being said, we're going to go ahead and dive in. Today we're going to talk about stocks versus the real estate market, right? So the first thing we're going to talk about is investment risk. The probability or likelihood of occurrence of losses relative to the expected return on any particular investment is the risk. The risk is also a measure of the level of uncertainty, of achieving a specific return as per the expectations of the investor being you, right? And so one of the things that I spoke about recently in a Facebook group that I run is really understanding your risk tolerance and your partner's risk tolerance, or your significant other's risk tolerance, and coming to an agreement on what that looks like, because we all have different risk tolerance levels, and that's a really important part of our goals. So one of the things we talk about all the time is goals. Investing is so similar to so many other things in life. You're not going to achieve your goals if they are not specifically defined and you don't revisit them often. So I encourage you, be really clear on your investing goals, whether that's general investing goals or real estate investing goals or both. Make sure they are clear, they are precise, and you know where you're going. So we've all seen typical warnings and disclosures on if you've seen any real estate investment that's come across your desk, any financial advisor will go over this as well. Any typical investment will say past performance is no guarantee to future results, right? This is our projection, which means that they are speculations. Nothing's guaranteed. You'll hear this over and over again, and that's because any investment, whether it's stock market, whether it's crypto, whether it's real estate or gold or anything else, we cannot predict what the returns will be. So today we're going to take a look at stock market versus real estate investments, the 4 basic risks of investing, how commercial multifamily real estate investments typically mitigate risk, and why I love them, and why the stock market can be much riskier than real estate. And I am a firm believer that that is in fact the case. So that being said, you're not going to look for investments that are risk-free, because quite frankly, there's no investment that is risk-free. Nothing's guaranteed, and there's always some type of degree of risk with any investment. You have to understand your risks really thoroughly. So you have to know what you're getting into, what your risks are. Depending on the risk level of the investment, you may need to go into it thinking, okay, this is what I'm going to invest, and if I lose it all, I lose it all, and that's okay, right? Or you may not. So just understand your threshold for risk and ensure that you are mitigating risk the best that you can. And again, that's going to depend on the investment type. You may be able to mitigate risks with real estate much better than something like crypto, but you want to make sure that you're mitigating risks where you can. So the first risk we're going to discuss today is the market correction. And this is a really important topic. You can talk to 10 people about the market correction and what's going on, and you're likely going to get 10 answers. Are we in a recession? Are we not in a recession? Is there a downturn? Is there not a downturn? Is there going to be a real estate bubble like there was in 2008? Is the real estate market coming down some? What is happening? What's going on with the economy? What's going on with the world? What's going on with inflation? The reality is no one really knows. No one has that crystal ball. So often one of the risks that they look at is market correction. So with the stock market, this is one of the most common fears and possibly the biggest reason investors remain on the sidelines. And this is for both real estate and the stock market. People have a fear of the market correction, or they're waiting to time it right. So they have a stockpile of cash. Oh, I'm just going to get in. I have to get in at the right time, right? Whether it's real estate or stock markets. And you can look at the stock market and you can look at the first half of 2022 and see that it has been quite a bit of a roller coaster, and there have been some corrections that have taken place. And you can also look, this recording is being done September 15th. So if you look earlier this week, just a few days ago, there was a huge market correction in the stock market. So that can go up and down and can be a little bit of a roller coaster. Some investors exit the stock market due to a downturn. I know someone that has historically done this, but that is when you realize your losses, right? So you don't actually, quote unquote, realize a loss until you convert that loss to cash, right? So some people will exit and some people are in it for the long haul and they're kind of waiting for the market to go back up before they start pulling out some cash, right? Or before they start exiting the stock market. I know a lot of investors right now, I don't really know what to do because I've lost money, but I haven't really officially lost it until I pull money out of the market. I don't want to be in the stock market anymore, but now I'm kind of stuck, right? And so the stock market often bounces back long term, but clinging to that hope can be really challenging, especially right now. And then when we look at multifamily real estate investments, recessions are often, whether or not we're in one, right, you're going to get a varying opinion. They're sometimes good for multifamily investments, especially within workforce housing. So recessions can be good. Often people may move from Class A or more of a luxury type apartment to Class B or C. Both C is more of workforce housing. And when layoffs or pay cuts occur, often homeowners will sell, right? Or renters of Class A will move to Class B or C. Also with the recent interest rate hikes, some homeowners or potential homeowners have been priced out of the market, or they're taking that wait and see approach, right? So they're saying, okay, I'm going to wait. I don't know if now's the right time. The market may go down. Let's hold off on buying a house for another year. Let's rent for a year. So we're hearing a lot of that as well. And during a recession, demand for apartments actually tends to go up. And because the demand is going up, it's a simple supply and demand equation. Because the demand for apartments is going up, it decreases the risk. So we all know there's a housing shortage, there's an apartment shortage. So because the demand is there and the supply is not there, that is a great way to mitigate risks. The second risk that we're going to talk about is competition. When you look at the stock market, and this is a really great analogy, is Netflix versus Blockbuster. And if you're not old enough to remember Blockbuster, it was awesome. We used to go on Friday nights, we used to go and get our, VHS, I think it was. It was like a disc, and you put it in and you'd have to rewind, or you would get fined and then you drop it off. Anyway, long story short, so you'd physically go get a video, watch your movie, make sure you rewind it, and make sure you get it back on time. But if you're looking at Netflix versus Blockbuster, so Blockbuster held the market for a really long time, but then Netflix came out and they ended up on top because it was the same or very similar audience, and they got ahead of technology and got ahead of consumer trends. Consumers don't have a lot of insight into technology development or company operations. So you don't really know a lot of what's going on behind the scenes if you're invested in a publicly traded company. Also, new competitors like Netflix can have a significant impact on investor returns because, in essence, it put Blockbuster out of business. And so when you take that and you compare that to multifamily real estate investments, your competitors in multifamily or apartments don't just spring up out of nowhere. So you have space issues, you have zoning issues, there's city approvals, there's entitlements before development. There are all these things coming. So you know if competitors are coming and you know what's on the horizon. Permits are limited. So cities and ordinances are not just handing out permits left and right for people to build apartments. When they are built, very often people will build luxury type of Class A apartments. Now, this is not always the case, but that is sometimes the case. So if you're investing in a B or C class property, then competition may not be direct competition, right? Because of the luxury apartments, it's a very different level of rents. Demand for workforce housing and affordable housing is on the rise. That's not going away anytime soon. So there's a huge need for workforce and affordable housing. We actually have an offering right now that specifically answers the need for workforce housing in an area in South Carolina. So the risk of high vacancy for well-maintained B class and C class apartments is really low. So you're going to have high occupancy. So the risk of high vacancy is really low. People are, when I mentioned the South Carolina deal as well, and a little plug, right? It's for accredited investors only. It's a 506C offering, but this workforce housing, it's a portfolio in South Carolina, and it's 100% occupied and there's a wait list. So this is what we're often seeing with affordable and workforce housing, and we're going to keep it in workforce housing and affordable housing. The third risk we're going to discuss is consumer behavior. So when you look at the stock market, it's filled with companies that create products for people to use, right? So you have Facebook, you have Apple for iPhones, right? You have McDonald's and Happy Meals and soaps, and there's a ton of consumable goods in the stock market. It's really impossible to predict the longevity of these products, right? So if you have, I don't know what other phones there are, right? Samsung and some other phones, right? You don't know how long they're going to have their run before Apple came into play, right? And so there may be something else coming back. Maybe iPhones aren't going to be the big thing, right? Or maybe it's, people are going, oh, I don't want, Happy Meals anymore. I'm going to go to, Steak and Shake. I'm not a fast food person. So if there's a better burger out there, let me know. Again, not a fast food person. But you can't really predict the longevity of these products. Blockbuster was around again for a really long time, but when Netflix came in with technology and consumer behavior changed, the company didn't change with it. And in essence, Blockbuster went down, but it also drug the investors down with it as well. And then there's been some issues, obviously, with Facebook lately. And then when you look at multifamily real estate investment and how that relates to consumer behavior, with multifamily or apartments, you are investing in a basic human need. It's never going to go away, right? So for centuries, for years, as long as humans have existed, we need a roof over our heads. And that's only strengthened over time, especially with the rising population trends, with a shortage of supply and increased demand. So the need for shelter is never going to go away. And there's a housing shortage, right? So we talked about that as well. The fourth risk is lack of control and transparency. So when you look at the stock market, I like to equate it to a roller coaster ride, the crazy train. And one of my mentors recently referred to it as the stock market casino. And I think that's a really great analogy. So there are a lot of ups and downs. So you may be in it for the long haul and you may be riding it out for the long haul. And that's pretty much what it's like, right? So you are on the train, right? Or the roller coaster, and you're in it to win it and you're not getting off, right? You're riding it for the long haul. And when things are going up, things are going great. But when things aren't going well, or there's a correction, there's a little bit of panic that sets in. So you think about a roller coaster, you're going along, right? Maybe up. When we start going like this, I start panicking a little bit. But if you're going up steady, it feels great, right? And you're like, oh, this is great. But then all of a sudden when things go down, you're like, ah, and you're screaming, or at least that's what I do. And my son makes fun of me. But there's a little bit of panic that that kicks in. And so this is really similar to the stock market and how some people feel. Also, if it's a train analogy or whoever's operating the roller coaster, the conductor or the CEO is unreachable. And so you better buckle up, or you're going to realize your losses, because if you take your money out of the market in a downturn, you're going to realize those losses. And you don't really know what's going on behind the scenes. As opposed to multifamily real estate investments, you know exactly who the deal sponsor and the operators are, and you can reach out to ask questions and get answers. We had an investor just this week reach out, and she had some questions on an offering that we had. And so we made sure we were able to answer every single one of her questions so that she felt comfortable. So you're not going to get this in the stock market, right? You don't have direct connection to the people running the business, but you do in syndications, you do in multifamily and apartment and passive investments. If you have questions, we will get answers for you. There's also multiple buffers in place to protect investor capital. There are buffers like reserves. Insurance is a big thing. Remember, this is a hard asset, so we have insurance, and we make sure that's in place. And we're working with experienced professionals, whether that's the sponsor or operator team, whether that's the property managers, the asset managers. We're working with an experienced team that have a resume. And then there's monthly and or quarterly updates for ongoing transparency. So you're not just left in the dark. You know what's going on, and you know how the asset is performing. If there are any issues, we're going to let you know as well. Here's the issue that came up. Here is the course of correction, and we'll circle back with how that turned out, right? So you're getting constant updates, you're getting asset management reports, and you can see how the asset is performing as compared to the business plan when we initially acquired the asset. Okay, so in conclusion, there's no one right way to invest. There is only one right way for you. And you have to make sure you're mitigating your risks, right? You have to make sure you're educated and you've done some due diligence. But the key is to invest, period. So you're not going to get where you want to be in your investment goals if you don't take action. And this is always one of my pet peeves. You have to take action to see results. So if you want to retire in 10 years, you've got to take action and help get yourself there. You have to understand the risks going into any investment, and just do it. So if there's money sitting in your savings account and you're sitting on a mound of cash because you're just waiting for the right time for the stock market, or just waiting for the right time for the real estate investment, newsflash, right? You have to realize with inflation at 8%, you're losing value in that cash sitting there. You're losing money every time it's not at work. So I highly encourage you to think about that for a minute and figure out what you need in your nest egg or your savings account or whatever it is. And whatever you do not need, you put it to work for you. You want your money to work for you so you can meet your goals. And if anyone ever offers you a risk-free investment or a guaranteed return, by all means, please run away as fast as you humanly can, because nothing is guaranteed. That being said, if you're interested and would like our free guide on 5 steps to building wealth as a real estate investor without taking on another full-time job, you can look at the link below, and I will include it in the recording as well. And then the QR code will take you directly to our interested investor page. So if you're interested in starting passive real estate investing, I highly encourage you to sign up. Even if you're not ready today, go ahead and sign up, and you'll start getting offerings, and you can start asking questions and get comfortable with the terminology and what returns you may get. And then you will be ready when the time is right. Thank you so much. I appreciate your time, and thank you for watching this. See you soon.